Market sentiment, the power of psychology. While well-educated analysts and accountants pore over EBITDA and myriad other figures, meanwhile the stock market does exactly what it wants to do. A news item today might spur the market higher, but the same news on a different day may cause the exact opposite reaction. So how do we solve this enigma to our benefit? We know that university degrees and diplomas are not the key to market success. They might get you a job in the securities industry, but the key to riches remains elusive. Yet we see some of the world's most eccentric dropouts making fortunes by clever trading and investing. How do they do it? Clearly, there is something else at work here. What is it? In a word, market sentiment. It is the most powerful market driver, and one of the least understood. Sentiment is a function of psychology. We know the market runs in cycles, and being out of sync can result in continual serial losses. To understand this aspect, it is good to be very cynical about what you read, especially if the story contains the opinions of others. Remember those three words: cycles, cynical, and psychology. I'll add another one: in sync. It is likely that your trading friends who can do no wrong live by those words. It takes years of experience for the penny to drop on all this. The market is very perceptive, and one of the keys is that we can always assume that, left field events aside, everything we read or anticipate is already in the prices. We hear phrases like undervalued, overbought, and others, meaningless terms. A stock's price can stay undervalued or overbought for years, without it ever coming into balance. Similarly, the price/earnings ratio may be high or low and remain so indefinitely. These figures only tell us where a stock is in relation to its peers. It tells us nothing about where it will be tomorrow. Tesla was overbought at $100. Tesla is actually a very good example of the power of sentiment. The true price is the one you see, here and now. Think about it. The price is an average of what every interested person thinks at this moment. Interest rates are going up? The market knows that. Real estate prices are too high? The market knows that too. The obvious question is then, what will change the price? The answer is, when the market psychology changes. What is Warren Buffett doing? He might be a legend, but what he does has a huge effect, seen even today. It's not a question of following him at all, but rather a question of taking advantage of the effect his actions have on the market. An example today. 2 announcements in New York, one would normally have a negative effect, one positive. Walmart announced horrible results, and WB announced a recent widespread stock buying spree. So who won? We did, as the market psychology swung to a positive outlook. The first indication of change will come when a good news story is ignored by the market. A warning sign of changing psychology. Sometimes we will read really bad news, which a reasonable person might think would have a serious effect on the price. But for some reason the price does not drop? What does this mean? It means that the collective wisdom of all shareholders, and would-be shareholders, has decided that the news is not so bad at all. So when a doom and gloom journalist writes a negative story and the price does not drop, my money will always be on the very positive sentiment that this confirms. This perception is especially useful when the market is in a major sell-off and a few stocks refuse to drop. They are the stocks I will buy, not the ones that have had the biggest drops and are a bargain. A stock is worth its actual price, so I either buy at the current price or higher. I never place a lower bid, because if it does drop, that confirms that the train is indeed going in the wrong direction. I don't want to be there. Until next time, trade safe.